Samiran, you seem to have smelt this trouble. 5.79. Now, what does this mean? Any hopes of a rate cut after the rupee threat is over also goes away?
Yeah, means I think this is a very difficult number to for the policymakers to handle, because this is now going to create a higher base for inflation, and from there to bring down inflation back to 5% or below is now going to be even more challenging. But I think I'm suspecting that the food inflation part, particularly driven by vegetable prices, is going to be the primary driver of this move. And also, to some extent, I think on the fuel price inflation, there has been some increase because of diesel and petrol increases, and some amount of exchange rate depreciation must have passed through the system by now.
Samiran, what's the trajectory now on the WPI? Because it was expected to remain subdued because lack of pricing power. Food was expected, to come down because of a normal monsoon. But now we've seen it go up, because of the rupee, etc. So what's the trajectory on the WPI inflation for the next 2 to 3 months? Do we see it inching higher and higher?
Okay, 1 second. Samiran, we'll just get back to you with the trajectory. I can read the internals. So you guessed it right. Vegetables is the biggest culprit. That one is up 17.7%, vegetables 18% higher really, and that has a decent 2% weight in the entire index. Of that, potatoes 16% and onions, we know that it is in the news, but it will become a bigger problem by the time we get to the August numbers. That one is up 31%. Year on year it is up 145%. So onions is the big culprit, but not the only one. We also have fibers, that is non-food articles, up 5.5%. That one's not very low. But the big culprit quite clearly is vegetables inflation. What about the others? Cereals also is not too, we should be worried about cereals rising month on month by 2.5%. Cereals is a big weight. It's about 3.5% weight in the index. That's risen 2.5% month on month. So year on year, it's a rise of 17.6%. So food articles as a whole rising by 11.91%. Not a very good number. Within fuel itself, like we told you, fuel inflation, 1 minute, there is fuel and power, the number is not very clear. But diesel prices have risen 26% year on year and 2.9% month on month. That clearly was the big number. We know that generally fuel index went up by 11.31%. I'm still trying to get if there is a core index number. But in manufactured products, other than plastic products, which clearly are a derivative of crude and therefore adjusted to rupee depreciation, that is where I think the depreciation has clearly shown. Plastic product prices, and that's okay, it's just a weight of 1% in the index. That's gone up month on month by 3.19%. Otherwise, I don't know if really the depreciation is showing anywhere, Samiran. About the only thing that's big is man-made textiles. It has about 2% weightage. That one is up 1% month on month. But besides these plastic products, I don't know whether you really have much of a rupee depreciation number over here. Any comments, Samiran, on the internals that I read?
It's quite clear that it's the vegetable and the cereal effect which is primarily dominating it. I think on the exchange rate depreciation part, we have to look at it slightly more carefully to see that to what extent the commodity index actually declined over this period. But the globally, but the inflation in India is not picking up that decline because of the exchange rate depreciation. So that could be one issue. But it's very clear that given the sluggish growth nature of the economy, even on imported goods, the pricing power is pretty limited, and that's why probably the pass-through is not yet complete. But on the trajectory part, I think now the critical component will be that with better monsoons, better acreage under production, would cereal prices come down in the months to come? Would vegetable prices with the new crop coming in come down in the next couple of months? If that's not the case, then possibly we are looking at a much elevated inflation trajectory going forward. So this is our hope that the better monsoons will actually increase supplies and bring these prices down as we move forward.
Very
it's an
quick.
all-food issue, but just to update on the bond yield, Indranil, if since you won't be looking at a screen, 8.55. So that's an 8 basis point jump after the inflation number came in. Where are we headed? I mean, 8.55, you won't buy bonds at this level, Indranil?
No, I think as I told you, I think the 8.50 has been achieved much earlier than what we were anticipating, and I think the inflation prints, both the CPI and the WPI, has just about taken off all chances of any easing bias on the monetary cycle, and therefore gradually I think the bond market should start looking at whether they should be pricing the assets at a repo rate of 7/4, which was the hunch belief, because everybody was expecting that this 10/4 measure of liquidity tightness may not last quite long. Now, on one side, that is lasting for a longer period than we anticipate, and there could be actually chances for the Reserve Bank to gradually turn around the monetary cycle if these are the inflation prints that are actually coming out. And I think in an attempt to also contain the structural problems that we are facing in terms of the CAD, it is but natural that we have to allow for a relatively higher real interest rates on the savings to also have an implication for the domestic demand for gold. So I think everything is playing together in terms of interest rates being sticky and on the higher side, and also possibly rising.
Just a word on the market reaction. The Nifty and Sensex, remember, were higher by close to about 0.5% before the inflation print. Now it's just clutching on to that 5,700 mark. The other reaction is in the Bank Nifty, was nearly up close to about 1%, has given up its gains. And of course, you can see the reaction in the 10-year bond yield as well. Indranil, what is the probability that you would assign perhaps to now the RBI considering repo rate hike?
No, I think we should not forget the sort of dynamic change in the monetary cycle that may be due, in the sense that some of the other competing emerging market economies, especially Indonesia, which faces more or less similar problems to that of India, has been hiking rates. So that let's not forget that. Now, the way I would possibly be looking at is what if they get a chance to move away from the 10/4 overnight rate, whether they would want to fall directly down to a 7/4, or they would want to buffer the system in terms of a little bit of a higher interest rate push from that angle. So there could be a thought process of the RBI to probably sort of maybe narrow the band with which we are operating at this point in time. But having said that, I am not really expecting the 10/4 measures to go away immediately unless the currency dynamics stabilize, and there is very little sort of opportunity that I am seeing in terms of the currency dynamics stabilizing immediately.
Okay.